Hello student, welcome back to IBS. Today we are going to discuss about income statement overview part 3rd. In this we are going to discuss about expense side of income statement as well as non-controlling interest kind of stuff. So let's jump to the topic and understand it one by one. Okay, so expense is an outflow. Outflow means basically expense are outflow or using up the asset. What we are doing, we are using our asset for what purpose or incurrence of liability. For these three reasons, if you have invoice, okay, if you have booked the invoices, expense to vendor payable, accounts payable part of the accounts payable will be your credit side. So that what you did, you have incurred the liability. Why you have incurred the liability? Because we have booked the expense, since either we have received the goods or we have rendered and we have consumed the benefit. So for that we have to create the liability. So when you have created your liability, or maybe you have purchased some asset, so in future you are going to get the benefit, but ultimately either you have booked the expense or you are going to get the benefit in future. But for that you are creating liability. For reducing this liability, to meet this liability, again you have to reduce your current asset to reduce this liability. So that is the definition of expense. So let's conclude this. Expense are the outflow or the using of the asset or incurrence of liability is part from delivering goods or service is a part of entity core operation. So that must be their core operation. Expense are normally kind of to pay their liability so that we can meet the expense. This is the overall definition of expense. There are two methods for recognizing the expense. First is recognizing cause and effect. We need to recognize when directly related to revenue. When you have sale for 100, for that you have product or service that cost is 80, that is directly related, as you know, direct labor, direct material, other direct cost, all are the part of your cost of goods or other indirect rent or whatever it is. So all those costs when you are considering in your cost of goods, so that is directly associated. Okay, so based on the cost, so what is the cost? We did sales, so if we did the sales we have to recognize the cost. So this is the cause and effect. And as the cost of goods when its item are sold, the same thing is talking about. Systematic and rational allocation. So costs are over time, such as depreciation of fixed asset, as we have discussed earlier also in the Excel sheet, in which I have mentioned depreciation costs are allocated based on JV, and that is based on the system automatic, based on system automatic or fixed asset schedule. Based on that, systematically we are allocating the cost based on rational allocation. Rational is based on our expectation of their lifespan, how much time it will take to consume the entire asset. Or maybe we have purchased a car, we are expecting that we will use in 10 years. We cannot use more than 10 years, then it will not be usable. So those costs we are depreciation based on this time span. So that is the rational allocation. And systematic is nothing, just a schedule how we have created in either in system or in Excel sheet, whatever the way. So this is the another method of allocating expenses. And immediate recognition, as and when it incurs. Expense that are not provide the future benefit are recognized immediately. And the another point is matching principle. Matching principle is expense are recognized in same period based on period factor related to revenue to match the cost with the revenue they help to generate. So this cost has helping to generate revenue. This cost is associated with this revenue. So that is why when as and when you book or recognize your revenue, similarly you have to recognize your cost also, that is related to your period cost. For example, rent, for example factory rent, and other maintenance for factory related costs. So these are the costs why we are doing. These are indirect costs, but we are doing to generate product, so our service whatever it is. And this product or service we are creating a standard cost. You must know about this. We are considering all our direct and indirect costs, and then we are defining our standard cost. So based on standard cost we are moving our cost to, whenever we are recognizing revenue we are recognizing our expense also simultaneously to this standard cost. But since this is not only associated cost, but that is also a period cost, as we have discussed earlier. For rent kind of stuff, for maintenance related stuff, if we are dividing total this cost and clubbing together and dividing by number of product, and then we are getting a standard rate. But at the end of the period, whatever product we have created, as given example, 150 product we have created, but we sold only 1000k product, so 50k product we have not sold. So for that, rent and maintenance cost will remain in your inventory, so that is not right. So that is why we have to pass the adjustment entry and recognize all those period cost to this particular period, whether you have generated sold the revenue or not. But this is again debatable based on the rule and regulation, whatever the IFRS and local gap or US gap, whatever they suggest, accordingly we have to take action. If they will say you have to book those period costs into that period, so we will have to pass the adjustment entry, or if they will allow or no need to book the cost, so we will keep this based on the standard rate. So matching principle implementation: expense should be recorded when the work or product contributes to earning revenue aligned with the effort of outcome. So when we are able to earn the revenue, this is not talking about the creating invoice or getting advance payment kind of stuff. He's telling about the earning revenue, simply revenue recognition. Revenue recognition we only do when we earn the revenue. So simultaneously their associated cost has to be charged. And the key point is the matching principle ensure that expenses are aligned with revenue to provide the clear picture of financial performance. So this is overall the explanation with regard to expense. So and another point, expense only incurred when you have any operation, when you have business, whenever you have any plan to generate revenue, sales or revenue. So then only you will incur your expense. If you are not having business, if you don't have any plan to sell or something, or if you don't have any business, then expense will not incur. So expense are normally incurred based on the operation or business. Now we will understand few other points with regard to gain and loss. By the definition, increase in equity from transaction outside the company core business. This is your balance sheet. This is your current asset. This is your fixed asset, current liability, long-term liability, and your equity. 100, 50, 50, and 100. What they are saying, how the gain incurred. If you sold any inventory and you generate revenue, that is your operational income from your core operation. So that is separate. Now we are talking about gain, not revenue income. When you sell any asset, fixed asset, for more than book value. So fixed asset was 100. If you sold it in 150, so what will happen? You will remove this to 0. This will be removed and 150 will be added to your cash. So what will happen? Instead of 200, right? Instead of 200, it become 250. So the impact of 50 will be increase here. Your equity will increase by 50 because your liability will remain as it is. Your long-term liability will remain as it is. How it will be increasing your equity? This will be work as in this way: income statement, revenue, expense, your operational. Then after operational, as we have other non-operational related, you have booked the gain of 150, and you must be not 150, you will book the gain added to net of tax. So maybe 50 is your gain, so 50 into maybe your tax is 0.3%. So after deducting tax, you might get somewhere 15 will be reduced. So 35 is your gain. So your equity will increase by 35. So this gain will be reported here as an 35 net of tax, not 50. Okay, 50 you cannot account here. You will show in your income statement as an 35 is your gain. So this what will happen? Your net profit will increase by 35. Net profit is linked with your equity in return earning, that will also increase. So likewise it will increase. So that is the thing they are selling, increase in equity from the transaction. Equity will increase from the transaction. This is the transaction. This is the transaction from the outside the core business, other than main business. If you sold any fixed asset, that is not your main business, but that is increasing your equity. This is the meaning of gain. I hope it is comprehensive explanation of gain. Selling of fixed asset is your gain. With regard to loss, is the same thing. If the asset was 100 million value and you sold it 80 million, so you will lose 20. So 20 you will not directly book into your income statement, 20, and if your tax rate is 30, so 0.6 million would be your tax asset that you can adjust from your actual taxable amount. So whatever your taxable amount, you can minus this amount, then you pay the balance to government. So this is the basic method with regard to losses. Let's read it out. The definition: decrease in the equity, just opposite definition, from the transaction outside the company core operation. I hope it is clear to you. The same example is also been given. Now we'll understand the key differences. Okay, revenue and gain. Revenue arises from company primary operation, sale from the product or sale from the service, while gain come from incidental transaction, any transaction which is not your operational, like asset sale. Expense versus losses: expense related to the core business, again main business, primary operation, and while losses are a result of incidental or peripheral transaction, like this way. Okay, note: point of view classification depend on whether transaction is a part of company main activity or not. So based on that, if it is not main activity, that will be considered under gain and loss. If it is related to your primary or main business activity, that will be your expense. I hope it is clear to you. So we are done for the day. We'll see you until the next session.